Common stock. People think it's safe because everyone owns it. Yeah, no, this isn't a savings account. This is the roller coaster. The higher the ride, the sicker your stomach gets. But if you hang on long enough, you're the one walking out with a gold ring. So let's not be cringy. When you buy common stock, you're buying ownership. That comes with voting rates. 1 vote per share. You pick directors, approve mergers. It doesn't make you powerful, but hey, you technically have a vote. Possible dividends, cash, stock. Maybe they show up, maybe they don't. The board decides you're not doing it. Now you can get cash dividends, you can get stock dividends, they can even send you product. That's on a quarterly basis usually, but again, the board decides, not you. You also get growth potential. That's the whole point of this. You want the stock price to rise. That's how you make money. And they're kind of efficient because even if they don't pay dividends, you're growing and you're not paying taxes on it. As it grows, you're paying taxes when you actually sell it. And if you hold it for more than a year, then it's a much lower tax bracket. That's called capital gains rate. Let's talk about what you don't get. No guarantees. No guaranteed income, no guaranteed price, no nothing. Bankruptcy, you're the last in line. Secured creditors, unsecured creditors, those are bonds. Then preferred, then you're the last one. But let's talk about the exam. Why do we do this? Great for long-term investors. If you've got time, patience, and can stomach the volatility, common stock historically builds wealth. Think retirement accounts, growth portfolio, stuff like that. It is risky in the short term. Like if your rent is due in 3 months, common stock is not a good idea. Money markets. Prices swing daily. One bad earnings report, boom, your rent money's gone. It's not for short-term conservative investors. If a client wants steady checks or guaranteed returns, go bonds and stuff like that and preferred stock, not common. Common stock is about growth, not safety. Not all common stock is treated equal. Saying I own stock is like saying I drive a car. Yeah, what kind? A beat-up Honda, a Ferrari, what? Same with stocks. So let's get into this. Blue chips, these are the giants, big established companies with solid reps, reliable dividends, and stability. Think Coca-Cola, Johnny John, Microsoft. They're not invincible, but as steady as it gets in the stock world, good for conservative long-term investors. Now we have growth stocks. Those are the fast-moving companies that reinvest profits instead of paying dividends. You don't get checks in the mail, but you might get a rocket ship of a stock. Perfect for long-term investors who can stomach risk. Terrible for grandma who just wants income. Value stocks, companies trading like on a discount. The market thinks they're worth less than they should be. So investors jump in hoping they're undervalued. Might be a steal, might be a trap. Best for bargain hunters with patience. Still going to get some growth on that. Now we have income stocks. These pay reliable big dividends. Utilities, older companies, they're not exciting, they're boring as hell, but they cut a check every quarter. Great for conservative or income-oriented investors. Now we have cyclical. They go up and down with the economy. Airlines, hotels, luxury goods, they go great in good times, but they do horrible in recessions. Suitable for people who can time the market. Most can't, so don't try. Defensive stocks, these are non-cyclical. These do fine even when the economy sucks. Food, healthcare, alcohol, shit like that. Utilities, people will still need it. Good for risk-averse investors who want stability. Then we have speculative stocks, the wild ones. Startups, biotechs, penny stocks. Could 10x or no, or go to zero. You don't put rent money there. Suitable only for aggressive gamblers who know they could lose it all. So think of blue chip as income. Defensive, safer, conservative, income-oriented clients. Growth, speculative. Cyclical, aggressive, long-term, risk-tolerant clients. Value, somewhere in the middle, works for patient investors hunting for bargains. So common stock is not one size fits all. You've got the safe dividend-paying grandma stocks and the casino-level thrill rides. Your job for this exam in real life is matching the right stock to the right investor. Because suitability isn't just a rule, it's the difference between being a trusted advisor or the fucking schmuck who put grandma in Bitcoin miners. So on that note, you don't want to always go to the most conservative way. You want to pick what's right for the customer. So comments like know the good shit, know the risks, and don't screw it up for the client.